On this episode of the AAF Exchange, the debt limit showdown, fiscal outlook woes, and the inflation stranglehold. Joining us to discuss all of this are AAF's Vice President for Economic Policy, Gordon Gray, and President Douglas Holtz-Eakin. First up, we are joined by Gordon Gray. Gordon, thanks for joining us.
Thanks for having me.
So it's been a fun week in your realm of things. Earlier this week, President Biden and Speaker McCarthy had a productive meeting on raising the debt ceiling, but there's still no deal. I mean, we've heard some snippets in and out of from the negotiations, but at the end of the day, we still don't have a deal. We're down to the wire here. Where do things stand?
So we are not yet the closest we've ever been to defaulting on our debt, but we're getting close. The closest we came, well, actually, in 1979, we had a technical default because essentially the machines that they used at the time to issue checks kind of broke because Congress did things at the last minute. But that was generally viewed as a little different than what we're dealing with here. That was, they blame tech support.
Always tech support.
Absolutely. But this is different, and this is shaping up to look a lot like the episode in 2011 where, we got within days of the Treasury very likely running out of cash. And, that's that X date that everybody talks about.
Yeah.
And June 1st is the best guess as to what the X date is, and it's getting close.
Yeah, so, I saw earlier, maybe it was yesterday, that we're in risk of losing our AAA. So it seems like we're getting close to the markets having a little jitters to all this going on.
Yeah. So and these are the things you start to see when you start getting close. So for good reason, financial markets hadn't flipped out or started pricing in much risk, if any risk, of defaults. The swaps market, the credit default swaps on U.S. Treasuries, the price of insurance has gone up, but that is the market for that. But the spillovers into the broader financial markets have not really been that pronounced, because the United States always eventually raises its debt limit in time. And so there's a degree of comfort even with what is apparently uncomfortable, to the extent that we're getting very close to the X date. But that faith begins to erode as our policymakers start to maybe think the unthinkable.
Yeah. So, the Treasury to this point has been able to meet its obligations, or using those measures that allow them to get past without going over the debt ceiling. But what happens if we pass the X date? Well, somebody's going to get stiffed on this in order so we can meet our obligations. Do they just simply stop? Do the government payments just simply stop? Or can Treasury still prioritize some payments, such as, Social Security benefits?
Yeah, so this is the multi-trillion-dollar question now, isn't it? So we know a little bit about the kind of break glass in case of emergency plans that exist, or the capabilities that exist in sort of extraordinary circumstances. And we're aware that the Treasury Department and the New York Fed have the capacity to prioritize payments, interest, and principal to U.S. Treasury holders, and that would be the first priority for making payments. However, there are other legitimate claimants to U.S. funds. That includes Social Security benefits. There's a $12 billion veterans retirement payment that's supposed to happen on June 1st. The United States doesn't have sort of a hierarchy of creditors. Essentially, all of these claims are legitimate. It is, I believe, a correct judgment that paying bondholders first is the wisest policy, the least harmful. But nevertheless, prioritizing payments in the absence of any legal structure is harmful to governance. It would, I think, lead to a loss of some degree of faith in the U.S. government and its just overall capacity to to function, and that will have costs for taxpayers and the economy.
Yeah. So I mean, and then we get to this debate, and it seems like oftentimes there is this discussion when we're talking about raising the debt ceiling. There is this discussion about fiscal responsibility and the impact of today's excessive debt accumulation has on future generations. What is your perspective on balancing the need to address the debt with the potential consequences of the default?
Right. So this is whether or not the juice is worth the squeeze, essentially.
Yeah.
And so far, we haven't had a perceived default, a technical default, or otherwise. So as yet, we have not really experienced much in the way of cost for the high stakes negotiation that's going on right now. And if it produces something that improves the budget outlook even slightly, well, then you could argue that it's worth it. I'm less convinced that it is, because the major drivers of the budget, the dire budget outlook, are major health and retirement programs driven by excess cost growth and demography. And none of those programs are on the table. And so unless and until you change those, you're not really materially altering the budget outlook. You can save money, and you can save a lot of money through the discretionary spending savings that are being contemplated, but that's nevertheless not where the real work needs to be done. And so I think the risk that we've talked about, they're entertaining a degree of risk that is somewhat novel, and in exchange for that, we'll get possibly a budget deal that won't meaningfully alter the budget outlook. So I think there's two ways to look at it. My own view is that it's probably not ultimately worth the risk.
Yeah, so I think that leads us to our conversation about the second topic today, which is the long-term budget outlook and the dire how dire it looks right now. I mean, so let's set aside the debt ceiling for now. We've been talking about this for a long time. I think we've been talking about this since I've started here at AAF, but not only in years before that, right? But not only has Washington done nothing to really address this, it's made the debt problem dramatically worse in the last couple of years.
That's what Congress has done.
Yeah. I mean, I think Doug had an interesting point either in his testimony yesterday or in one of his TV hits that it was, like that the word debt and deficit really didn't even come up in the last administration. And obviously the previous administrations just did a lot to add to the debt. So, I mean, there doesn't really yet seem to be any, for most Americans, there doesn't yet seem to be any negative consequences.
Nope.
So there's no pressure on politicians to do anything. There's no groundswell here. When and how might this actually change?
There's no constituency for the types of budget changes that are needed, because the budget changes that are needed are some combination of higher taxes and lower spending. And that is sort of the functional equivalent of, diet and exercise. And nobody likes doing that, right? Like, nobody wants to campaign on eat your broccoli, for goodness sake. No, you want to campaign on, here's your ice cream cone. Here's your, here's your new entitlement program. Here's, and that's basically been the approach we've seen from Congress. It's a bipartisan appetite. The President Obama basically said there's no budget problem that couldn't be solved if by taxing billionaires. Donald Trump came in and says you don't have to touch the major drivers of the budget challenge in Medicare and Social Security, and the current administration thought that $3.5 trillion was sort of the opening bid on or the compromise on a $6 trillion domestic agenda. So the appetite for blowing the budget deficit out is bipartisan.
Yeah. So what are the major challenges and risks associated with the current budget outlook?
So the risks are that the rapid accumulation of debt will essentially shake the confidence of bondholders, and the U.S. will face a sovereign debt crisis. That's sort of the extreme scenario, the U.S. Turning into Greece.
Yeah.
And on the scale, on a superpower scale. That's the worst case scenario. To me, the more likely scenario is muddling through. We'll incrementally raise taxes, we'll do modest spending reforms. So the taxes will, we're going to end up kind of heading in the direction of Europe with higher taxes, lower growth, more regulation, a less dynamic economy. And that's my concern, and we'll call it fine.
Mm-hmm. Yeah, you say Europe, and France is dealing with these things right now, and it's like this is the trailer.
Yeah, and the reason why is because successive generations of politicians have convinced the American people that you can have as much government as we do without paying the full freight of it. We are addicted to deficit spending. We are addicted to here's all the benefits and all the services and all the costs and all that entails, and we will tax you at a level that is insufficient to cover that appetite for spending. And we've convinced the American people that is sustainable and durable. And it sounds great. But it's
who doesn't want their cake and eat it too?
Yeah, exactly. But it's not sustainable and durable.
Yeah, so I think it's going to be an interesting week ahead for the debt ceiling, but hopefully it will also continue to drive this conversation about fiscal responsibility and maybe get to somewhere better. So, Gordon, thanks for joining us and updating us on all these fun topics.
Thanks for having me on.
Now let's bring in AAF's president, Douglas Holtz-Eakin, to give us his read on the economy. Doug, thanks for joining us.
My pleasure.
All right, so before we get into the economy conversation, we always love to hear your rant, so take it away.
This week's rant is poverty measurement.
Yeah.
The official poverty line was drawn by Molly Orshansky in 1965. She looked at the cost of an adequate diet for nutrition purposes, calculated the average family spent a third of their money on food, and so just multiplied that cost by 3 and says, if you have that much money, you can eat well enough to survive. Above that, you're good. Below that, you're bad. That hasn't changed since 1965. We have indexed all sorts of programs to the poverty line. And you get Obamacare up to 400% of poverty in the original incarnation, things like that. Why hasn't it changed? Because it's a value judgment in the political system to make a big change like that. Does it accurately measure poverty? No. Everyone agrees with that. We had a supplemental poverty measure come out in 1995, and most recently, the National Academy of Sciences put together a panel and said, think about it again. And they came up with another refined measure, very elaborate, but the important thing is the first recommendation in the report is use this to replace the official poverty measure. Mm-hmm. No. That would cost over $100 billion over the next 10 years. That's a decision Congress should make, not the Census Bureau and not a bunch of geeks at the National Academy of Science. That's what I'm all spun up about.
Yeah, I mean, it seems like something that they want to just get through there, but it does have broad policy implications for a lot of those programs out there. A lot of the who gets funding for what and all this stuff. So it's something important that should go through regular order.
Right, and so, for example, Medicaid, we moved eligibility up to 138% of the federal poverty level. Okay, other programs, Obamacare, 400%. You change the bottom line index, you change all these programs in ways that they didn't originally see them as being configured, and so they'd have to redo all the programs. Mm-hmm. It strikes me as hijacking the policy process in a way that's completely inappropriate.
Yeah, I could tell when I read that dish that when you wrote it as more of therapy for yourself.
As are most of my writings.
That's why we added this rant section to the podcast, because we know it's good therapy for you to get through.
Option 1, vent in the dish. Option 2, turn into the Hulk. I mean, you got to pick.
All right, let's talk about the economy and, of course, the stubbornness of inflation. It's very stubborn right now. I mean, it seems like they've been working at this for over a year now, and it still hasn't gone away. The latest data did have some signs of relief, though. You noted, I think, last week that in the critical area of shelter, we've started to see something. We've started to see some relief. What is your read on this, and all the other inflation data out there?
So point number one is we were warned when Powell announced the tightening cycle way back in March of 2022. He said it could take till 2024 for us to get back to our target. They're now thinking maybe 2025. So we should always have been thinking in terms of years and not months and quarters, but people get impatient. The big news was the shelter inflation. That's been rising every month since January of 2021. It finally came down year over year from 8.2 to 8.1. That doesn't sound like a lot, but the monthly shelter inflation has dropped from 9% annual rate to 5% annual rate in the past 3 months. So that's long-awaited softening of the apartment rents market, essentially. Good. And this gives them enough wiggle room that they can do what they want to do. And my guess is they're going to decide to pause at the June meeting.
Yeah. So, sticking with the shelter inflation for a second, that's a lot of that's because people sign these 1 year. Nobody does on a month-to-month basis. So that's where most of the stubbornness is coming from on that front.
Yeah, your personal shelter index doesn't change for 12 months.
Right.
And then, maybe the rents only went up 1%. Now you show 1% inflation, whereas you've been walking around with a rental contract that showed 9% inflation from the past. That's just finally showing up in the data.
Gotcha. So the June meeting is coming up. We just got the minutes from the last meeting. Despite a lot of differing opinions among regional bank presidents, the Federal Open Market Committee has remained pretty united. But as we saw in some of the minutes from the last meeting, there is more of a debate going on. Will the committee continue to maintain its unanimous decisions in the upcoming June meeting, or what are we looking at?
I don't know. Honestly, I think the chairman's done a really good job of getting unanimous support for the final decision, 25 basis point rate hikes, despite clear disagreements among the members of the FOMC on the need for additional tightening or the expected need for additional tightening. And the real issue is, I think, how much forward looking you want to be in your decision making. The staff forecast is we're going to go into a mild recession fourth quarter this year, first quarter next year, and then we'll come out. Inflation will drop fairly dramatically. If you're a member of the FOMC who sort of thinks that is the future, you don't want to raise anymore. They've done their job. If you are a member who thinks, look, we don't get any credibility by saying our staff's really smart. They told us that inflation was transitory too. That didn't work out so well. So let's wait until we get a demonstrated decline in inflation, and that says keep raising rates, or at least just pause. Don't go on hold permanently.
Yeah, I think one of the interesting conversations we had when the many conversations we have preparing for this podcast is that. Are you reacting, because reports are always about looking backwards, and you don't always know what's out there. So do you have to see a market success before you're allowed to pause, or do you have to
This is one
just
of these.
guess?
This is, all parents understand this, right? What you say matters, and what's the stance you're going to take, and what Powell has said, sort of fairly consistently, is they want to see an actual decline in inflation toward the 2% target before they stop making monetary policy more restrictive. So, on that note, we haven't seen a dramatic decline, but if you're thinking, what we can anticipate one instead of actually seeing one, then you might want to stop here. The other thing that's worth noting is almost everyone makes the point that rates aren't the only thing that produce tightening of financial conditions, and people think that the Silicon Valley Bank episode is going to cause credit standards to get ratcheted up, fewer loans are going to be made, so it's tightening on that basis. And if you keep rates constant and inflation declines, real rates are rising. So for lots of reasons, you could be getting more restrictive policy over the second half of this year, even if they don't raise rates.
Gotcha. Yeah. To nobody's surprise in this, many on Wall Street are even calling for a rate cut on this. I can see your blood boiling already on this one, but
forget the poverty measure. This irritates me.
We're gonna give you a second rant to end today. To what extent do you think pressure from Wall Street impacts the Fed's decision-making process regarding interest rate adjustments.
These guys can whine all they want. And this is the easy money camp who had zero rates for years and years and years and now have to manage interest rate risk and do things that they hadn't had to do before. And God forbid you should earn your millions of dollars. So they're not going to care about that. They will care if equity markets, bond markets, capital markets in general transmit negative shocks to the real economy and thus endanger employment and their mandate for full employment. So they care about the transmission and they watch markets carefully for that, but they don't care about the markets per se. They're a means to an end for them.
Yeah, I mean, this interest rate risk management has already shown up in part of the banking problems. I mean, it's there. I mean, it's clearly a problem that Wall Street has to deal with, and like you said, the easy money folk obviously want to go back to the easy money.
And you hear a lot about this, but it's again, the Fed's very powerful, and you at your own peril bet against the Fed. We have people who think that interest rates are going to decline by the end of the year, but that's been narrowing. They were about 100 basis points away from the Fed a while back. They're now 30. And by the time we get to the end of the year, they'll be in lockstep.
Mm-hmm. Well, I believe you're on vacation for our next recording, but next time you come back, we'll have to talk to you about what happened with the June meeting and see if anything changes.
Can't wait. Should be fun.
Thanks for joining us. I hope you enjoyed this conversation. Tune back in for our next episode, where our experts will provide clear, data-driven insights into today's economic and domestic issues. I'd also encourage you to check out any of the links in our show notes and also follow us on social media.